This is Matthew Cratter from Trader University, and today I want to answer the question, will the housing market crash? We're in July right now of 2020, and this is a question that I've been getting a lot. If you're interested in learning how to make money in the markets or just want to see what I'm trading or investing in, be sure to hit that subscribe button. So we have this saying that generals always fight the last war, and I think this is true for markets and investors and market participants as well. And so people are often worried about a repeat of what happened in the last recession or the last crisis. And we definitely did have a big housing bubble that sort of built up from 2002 to 2007 and then deflated for a couple years, almost blew up the whole US banking system. And I think a lot of people who lived through that and were obviously traumatized by it, as we all were, are expecting something similar to happen. But what I would suggest is that the same thing never happens twice, or certainly never happens in a row. There has to be a whole generation that lives and dies, and the sort of collective memory has to move beyond it. So, for example, there's a stock market bubble that burst in 2000, and so everyone put their money into houses, thinking that stocks were really unsafe. And then, of course, people lost more money in their houses than they had lost in the stock market. So I think this is a similar situation. In that 2002 to 2007 period, there were a lot more speculators. There were lots of TV shows, how I made $5 million flipping 20 homes in a year. There's a lot of leverage. There are a lot of weird products, a lot of weird mortgage products like option arms, you may remember, interest-only mortgages. And there's been a lot of reforms of the U.S. financial system since then. The U.S. banking system is much more healthy. It's much less leverage. It's not, you don't have banks like Lehman Brothers, which was leveraged like 40 to 1 or 50 to 1, countrywide mortgage, etc. And so I think it's a completely different situation. If you just look at the headlines, it seems somewhat similar, very, very ominous headlines like this, like 32% of U.S. households missed their July housing payments. I guess this would include rent and as well as homeowners with mortgages. When you drill down into an article like this, it looks a little less severe. What really happened is people were late. At least for June, by the end of the month, almost 90% of households had paid some or all of their rent or mortgage payments. I think this is a different situation because it's not really a speculation situation. We obviously have the COVID crisis. We have a lot of people out of work. And as a country, you cannot evict or foreclose on 30 or 40% of your population. It's the old saying, if you owe your bank $1 million, the bank owns you. If you owe the bank $1 billion, you own the bank, basically. It's a similar situation here. If enough people are in trouble, it becomes something that needs to be solved by politicians. And so as a result, I don't think that there's going to be a deep housing pullback here in housing prices. We've seen a little bit of a pullback, which I'll go over in a minute. But what I think is going to happen, just as has been happening with the stock market, is the Fed money printing will continue. We're not going to get a stock market crash. We already had that in March, and we had a very quick recovery. And something similar is happening in housing. The Fed has obviously lowered interest rates a lot. Mortgage rates are very, very low. And something sort of different happened in the Fed was raising rates from something like 2004 to 2007, and they really kind of blew up the housing market in the process. We have the exact opposite situation here, where mortgage rates are just unbelievably low, and the Fed is printing money, and also the government is sending out checks. And it looks like, I'm not sure if this headline is correct, but if the COVID situation continues, if various quarantines and lockdowns and shelter in places continue, if the unemployment rate stays as high as it is, there will be stimulus checks. There will be more checks in the mail from Trump or from whoever is our next president. It's just guaranteed to sort of shore up the financial system. Now, whether this is a good thing or a bad thing, you can debate it. But as a result, I don't think we will see a pullback in the housing market. Now, one of the problems with having lots of money printing is it devalues the currency. Now, when you're devaluing a currency, especially a world reserve currency like the US dollar, the result tends to be that you drive up the price of gold, you drive up the price of scarce assets like Bitcoin, like stocks, like real estate. And so we've seen a little bit of a pullback. We can look at San Francisco here. There's been little bit of a pullback since March, as one would expect. Obviously, maybe fewer people are even shopping for homes, or if they're doing online. But if we go through these charts, they all look pretty much the same. A little bit a shallow pullback since March. So San Francisco, Denver, which is the area I live in, a little bit of a pullback, and these are all sort of hot markets. Austin chart looks similar. West Hollywood, I could have picked any neighborhood in LA. West Hollywood, Del Mar, which is near San Diego, Southern California, very similar chart. If you look at a chart of something like Manhattan, it's really been pulling back since late 2018. And I'm not completely up on this market. I'm not sure the reasons for it, what's driving this pullback. But this was a pullback that was underway even before COVID. And obviously with virus pandemics coming through the world neighborhoods, it becomes much less desirable to live in places that have elevators, to live in places that are stacked on top of each other. So I would say I'm very bullish on single family homes in the kind of neighborhoods that people want to live in. And I hate to say this, but I would tend to say it's the kind of more expensive neighborhoods, the kind of more desirable neighborhoods, places to live. As we've gone through here, the Bay Area, Denver, parts of Texas, Southern California, I'd probably include Seattle as well, etc. Florida, places with sunny weather is often obviously a bonus. And so what we're talking about here is real estate as a store of value. I'm not saying there can't be a short-term pullback here. Maybe the U.S. real estate market pulls back 3 to 5% over the next 12 months, but based on what I'm seeing, I don't think it's going to happen. And as a result, the worst place you can be is sitting in cash. If you're sitting on a lot of cash, you really need to get your cash into scarce assets like Bitcoin, real estate, gold, etc. So people have been asking me about specifics of real estate. None of this is investment advice. This is just my 2 cents, but I'm very bullish on single family homes in areas where people want to live, in good areas, and much less bullish on condos or townhouses. There's much less room there for, obviously you have the problem with shared elevators and common air systems and these kind of things that are definitely less desirable now that we know that things like COVID exist in the world, and who knows what the next pandemic will entail. But the nice thing about single family homes too is owning if you own a little bit of land, even if it's just a postage stamp amount of land, there's a lot that you can do with it. You can build up, you can build out a little bit, you can do more remodeling, and you're much more constrained if you're in a condo situation or a townhouse situation. Obviously, if you're on Central Park or something like this, there are exceptions, or incredible views somewhere in Los Angeles or in Hawaii or in Southern California. But in general, single family homes I think is the place to be. A bonus obviously is nice sunny weather, low humidity, lots of sunny days. And then obviously location, which includes the weather piece. It also includes sort of a good, stable local economy, good jobs, preferably high-tech jobs, and good schools, good safe schools. I would say that unless you're sort of a prepper or something, and we're talking here about what investment should perform the best. So if you're interested in your house as more of a consumption item or as a citadel or a fortress, obviously you'll have different considerations. Or maybe you just want to live in the kind of house and the kind of place you want to live in. It won't have great resale value, but it doesn't really matter because you get to enjoy it. But I'm talking about sort of what I think will do the best from an investment standpoint. You don't want to be in the middle of nowhere. I actually love Nevada. I think it's beautiful. But you don't want to be in the middle of the Nevada desert, 100 miles from the nearest gas station, if you want to have a lot of appreciation. The key is scarcity. So if you're close to a beach, if it has views, if there's a river or lake, these are signs of scarce properties. Also properties in good school districts. Or, for example, properties close to Amazon or Oracle or Microsoft, various Microsoft headquarters. These are good places that people want to live, where they can shorten their commutes. If you have a nice flat backyard, that's always a bonus. Sometimes you get a view instead of a flat backyard, and then you've got a sloping backyard. But kind of your classic family home, flat backyard with maybe a tree to hang a rope swing from, walking distance to good schools or close to a good park. And I've been looking at a lot of rural properties, ranches. the really big concern there is broadband internet. In this day and age, if you want your property to have a good resale value, you want to make sure that there's a good internet connection, that you don't have to use satellite internet or something like that, which is really slow, or I forget what it's called, DLS. Some of these old versions of the internet. Another nice metric is just where are their Pete's Coffees, where are their Starbucks, where are their Whole Foods. These kind of things can be indicators, especially Whole Foods. They tend to put Whole Foods, obviously in more expensive areas, but also more desirable areas. And then the last thing I would say is, from an investment perspective, get a normal house. And we're talking about whether a house for yourself or for investment property, but nothing too weird. You don't want something that looks like this unless you really like it and you want to live in it. But then it can be much more difficult to sell. So anything that looks like this, or a dog house like this, very cool, but not a good idea from an investment perspective. There are going to be very few people who are going to want to buy a house that looks like this, and it's going to be very difficult to come up with the comps for it in terms of what it should be valued at. So then you're sort of at the risk of dealing just with very idiosyncratic buyers. If you want to learn more about real estate investing, I actually made a whole course about this that's available with all my other paid courses on Trader University. So I've got a bunch of lectures here. I'll stick a link in the description notes below. But if you want to understand how rental yields work, cap rates, some of the math behind real estate investing, how to know how much to pay for a property, and then I also have a lecture here on kind of examples of rental properties that I've owned in the past, how to find a great property management company, REITs, all this sort of stuff that's related to real estate. And you can get access to this along with all my other courses, including Learn to Trade Stocks Like a Pro. Your membership gets you access to all 13 courses. So if this is something that interests you, just click in the description notes below. You can click on any of these courses and sort of click through and see the lectures. And then at the bottom, if this interests you, you can click Get It Now, which will take you to the checkout page. And I wanted to give you a special coupon as one of my YouTube listeners. If you scroll down here to where it says have a coupon code, and you just type in YT99, as in YouTube 99. Normally access is just $125 for 30 days access, but this coupon will give you $26 off. So you click update, that'll take $26 off, and you'll get access to all the courses, including the real estate investing course, for just $99 a month. And there are no long-term contracts or anything like that. So you can cancel at any time. You can watch all the courses, watch the real estate course, and then cancel, and you won't be charged again. If you found this video helpful, please hit that subscribe and like button. Let me know your questions and comments in the comment section below. And thanks a lot for listening. I'll see you in the next video.